what's up, all of you beautiful subscribers? Welcome back to the Jack Chapple Show. So Alibaba has had a really strange day, to say the least. So they released their earnings reports, and then investors got really happy for like 5 minutes. And then they got really angry and we're not having any of this. And then the stock dropped very quickly. So we're going to take a look at their earnings reports here. Now, I did an Alibaba stock analysis a few weeks ago, and it kind of took a deep dive into the infrastructure of the company. So if you want to know more about the company as a whole, go look at that video. But for now, let's just jump right into why investors are kind of scared. All right, let's take a look here at the revenue here. So from a macro perspective, again, this is another tech company where it looks great on paper. Let's take a look here. I mean, revenue from this time last year was $55 billion. That's jumped up to $85 billion, and that's about a 54% increase. And for a multi-billion-dollar company, a 54% increase in revenue is like, it's just mind-blowing. It's like, all right, if you have a 20%, that is really good. 30% is just amazing. 54% is like otherworldly. So it's amazing for this company. So even if you were to break this down, I mean, for their upcoming revenue, for their new income streams like cloud computing, that's up 90%. That's really great because Amazon kind of owns that right now. So it's really great to see Alibaba just clawing into that. That's where they could potentially make a lot of money. As you guys know, that's how Amazon is actually profitable. I mean, Amazon may have actually made a profit on their shipping, like barely, for the first time in the last quarter, but they've been profitable as a company for a few years now, solely because of their cloud computing. Their cloud computing, it's like 80% of their revenue or something, or 70% is profit. And so Alibaba, that's a good thing that they're getting into now, so that they could potentially take some losses in other areas and they could grow that cloud computing, which is a very high margin industry. Let's take a look here at their core commerce here. Their commissions are 31% growth. Customer management, 25%. Others, 151% increase. Commerce wholesale's up 37%. I mean, this all looks great. And so, taking a look at their profits here, they beat expectations. Again, they're a profitable company. They beat expectations by 30%, meaning that they exceeded Wall Street expectations in profitability by 30%, which, again, if you were to just be this or any other time for a tech company, this stock would have gone through the roof. However, unfortunately, this is not a normal time for tech company, especially Chinese ones. So, as you guys know, the last month for tech has been really horrible. The worst month since the recession. But the other thing here's the why I think that investors didn't have the stock just stay at a high level after the earnings report came out, is because, here's what they said. This was word for word, and it was just one sentence. Just in the past month, global macroeconomic conditions have become more uncertain. And so people wonder about potential reverberations from global economic slowdown, the threat of rising interest rates, and political debt turmoil in Europe. And they talked about a bunch of other stuff too, but that's why I think the stock went down, is because before they even announced anything, really, that's what they talked about. They talked about, we could be, what they were trying to say is that a recession could be hitting soon. There's been, there's been a US-China trade war, which could be hurting us. There's been rising interest rates, and economic growth has not been great recently. And even though jobs numbers have looked good in the United States. So that's what they started it out with. And maybe those few sentences there, that might be why the stock went down. But, I mean, they're right about all that stuff. It's really interesting because they're right. I mean, all that stuff is happening. And, I mean, today Trump said potentially that he's going to sit down with the Chinese, whatever, president or prime minister, whatever they have. And it could be coming to an end. He's had very good talks over the phone. Maybe they won't have a trade war coming, or the trade war will be over, however you want to view it. But investors didn't like that. Investors did not like that announcement. So maybe that's why. I think that Alibaba jumping into cloud computing, that is a big innovation that they've jumped into. It's a copycat because they're lagging behind Amazon by about a decade. That's when Amazon started it, about 2005, 2007, somewhere around there. So they're lagging behind, but they're trying to innovate. They're trying their best. They're buying out other companies. They're buying out other e-commerce platforms. So I think in my personal opinion, the numbers had nothing to do with Alibaba stock going down. Zero. It was just more of the macroeconomic situation, which we have seen in tech for the past month. So what do you guys think of all this? Let me know in the comments down below. What do you guys think of Alibaba? Is it, would you invest in them? Would you not invest in them? What do you think of the whole situation? So there's actually two more things I just quickly want to talk about here, not regarding Alibaba. So the next thing is just quickly, Toys R Us. So Toys R Us is going through a revival. Kind of. At least that's what people want to say. It's not. So this is just kind of a funny story before we move on to the next series topic here, is that this month, Jeffrey's Toy Boxes displays will appear in 600 Kroger family of stores, a chain of grocery and department stores across the country. The boxes will feature 35 priced toys from 20 bucks to 50 bucks, including exclusive from brands such as Animal Zone, Imaginarium, Journey Girls, Edu Science, You and Me, and Just Like Home. And this is, I mean, I don't know what's happening here. I guess that they're just trying to stay in the public eye, try to start something else by using, I don't even know if someone else owns Jeffrey, the giraffe or whatever, but anyways, I've said rest in peace to Toys R Us before. I mean, we'll see what happens. They're already bankrupt. It was just kind of funny and also heartbreaking to see that this giant commerce toy retail store, which was part of my childhood, a large part of it. I would go there. I stopped going around the time of 13, 14 years old. That's when they started going downhill. But they were a large part of my life, and now what they're clinging to is their mascot, which is very, very sad and unfortunate. So then the next story I want to get to here is Starbucks. So Starbucks stock has gone up, I think about 9% as of today. So why is this? Why did this happen? It's for two reasons, and one of which has to do with actually Alibaba. So a big reason why the stock went up so much was because earnings for Starbucks went up 13%. Revenue rose by 9%, so the revenue for last quarter was $6.3 billion. And that was a big reason why the stock went up. Starbucks looks like they're actually having some growth, which people thought that they couldn't get because they couldn't get in. People weren't believing that Japan and China were going to continue to be a growing market. So again, the revenue and earnings rose, but one of the big reasons was that they partnered with Alibaba to deliver. They're going to have a very quick delivery service, which they're being aided through, they've partnered with Alibaba for that service. And they said that so far they're very optimistic about Starbucks delivery in China, adding it will be a delivery unlike any other competitor is doing in the market. And it will share more details on this on December 13th in New York on Investor Day. The company, so they've already tested deliveries in Miami as well. Everything seems to be going really well. So people are positive on this because, as you guys know, it's the people want things quick. I mean, that's one of the reasons why on Joisk we have 1 to 2 day delivery, except for Canada at least. We have it for Canada. For US, it's 3 to 7 days. For worldwide, it's who knows. It's just it gets there when it gets there. Sometimes I think it takes somewhere between, from what I've seen so far, the quickest has been 5 days, and it's taken up to 2 weeks to get to some places overseas. But people want stuff quick. And Starbucks is getting into that. People don't want to get up and move, and a lot of people aren't having cars, especially in cities now. So I'm interested to see how much people will pay for Starbucks delivery. The cup of coffee is already expensive. It's can range from $4 to like $9 for coffee if you just go there. And the fact that that might actually increase for delivery, it might even get up to $15 for a coffee or something like that. I mean, I'm sure that there's some wealthy people that are willing to pay that, but I'm guessing the average consumer will not. And yeah, so what do you guys think of this? What do you guys think of Starbucks delivery service? Are you guys optimistic on this? Let me know in the comments down below. I think it's an interesting idea. It's like, what if a company like McDonald's, like a place where you normally have to go to the place to get a good quality, well, McDonald's quality, whatever. But what if McDonald's were delivering, weren't to partner with something like Uber Eats? What if they just did it kind of in-house? That's kind of what Starbucks is sort of doing a little bit. But I don't know. I'm interested to see into seeing what happens here. Hopefully, that'll help increase their revenue, I don't know if it'll increase their profits. We'll see what kind of, they're going to reveal more on this product or service in a few weeks or in about a month and a half. And I want to see if it'll actually be profitable or not, because delivery is tough, man. I mean, running a delivery company like me, like part of its delivery, you take that into expenses, it's tough. It's tough to break profits with a lot of items. So I'm very, very curious to see how they could, I mean, one of the things about the food and beverage industry is that the margins are already very, very low. We're talking Howard Schultz, the CEO of Starbucks. He went on How I Built This from, it's a podcast by NPR. He was talking about how the profit margins on every cup of coffee could be from 1 to 5%. And those margins are so low where if you wanted to add any additional expense onto a sale, that is very, very difficult to become profitable. So I'm curious as to how they do this. But for now, I think that's going to wrap this video up. So what do you guys think of all this? What do you guys think of the Starbucks and Alibaba and even Toys R Us, the giraffe? Let me know in the comments down below. Remember to leave a like on this video and subscribe. And last thing, check out joisk.com if you want to support this channel. We have a big update coming soon. And for now, I think that's going to wrap this video up. I'd like to thank you very much for watching. You are all very beautiful people, and I'll see you guys in the next video.